The banking crisis does not appear to be over like everyone says it is. Banks are in real trouble, but it can present some opportunities to us as real estate investors. We're going to talk about that on this episode of Real Estate Revenue. Hey everybody, welcome to Real Estate Revenue. I'm Paul Airy, and in this episode, we're going to talk about banks, how much trouble they're in, how it's really a lot worse than what they're saying on TV. I watch the financial news networks, and they're kind of glossing over this whole banking crisis thing, making out like it's gone, it's done, it's not going to get any worse. They are starting to talk a little bit about commercial real estate now, and this is a lot bigger problem than what they seem to be presenting to us on television. So, you know, it used to be that YouTube was not necessarily the most reliable place to get your news, but it's kind of flip-flopped, and now it's a whole lot more accurate than what you're going to see on television, on the news networks, and I'm sorry to say even Fox Business News. I've always been a fan of that station, but I mean, lately they just haven't quite been cutting it as far as getting the truth out. So here we go. What is going on with banks and what's going on with commercial real estate? So here are a few of the YouTube titles that I see on various people's videos, various YouTube channels and I want to go through some of these just to kind of highlight a few of the things that are going on and discuss whether or not these are real and accurate. So the first one, banks are dumping mortgages. 422 banks have insolvency issues. Bankruptcies are up 45%. New home buyers are walking away. Agents are out of work. They're talking about real estate agents here, and that's true. A lot of real estate agents are just quitting, walking away from the business. More big price drops are coming. $1 trillion defaults. Not real sure about that one, but I would not doubt it. Home builders in trouble. That one absolutely is accurate. For the most part, these are all accurate. Maybe a bit of a stretch on a couple of them, but not by much. These things are actually happening. They're not getting talked about a whole lot. And I try to choose the most accurate people on YouTube to watch, especially about banking. And I choose to watch Stephen Van Meter on that front about banking and in the banking crisis and what's going on. So most of these video titles here that talk about banks, I believe including the one about bankruptcies, are from him. And guy's got some really good data and backs it all up. These are pretty scary video titles. So it doesn't mean the world's coming to an end. It's actually a good chance for some opportunities for us in real estate and in other areas, other businesses, other investment opportunities. So we're going to get into that a little bit in this episode. Now, when you do hear people talk on television, on the financial news networks about commercial real estate, usually in the past, everybody seems to be a little confused about what commercial real estate is. Either that or they're just not including everything for one reason or another. Now, lately, all they talk about is office properties. And actually, they are in some serious trouble, but they are not the only ones. That's not the only property type in commercial real estate. And it's not the only one that's in some trouble. So, you know, we have four main property types in commercial real estate. There's office, industrial, retail, and multifamily. And all of those are going to have their own set of issues, and they all stem from a financing standpoint, the mortgages that are on these properties, and how commercial real estate financing works. It's a lot different than residential financing. When you buy a house, you go get a 30-year mortgage. That's it. Pretty much you pay on it until you're ready to sell or until you pay it off. Commercial real estate is not like residential. Financing is completely different. Loans are amortized for 10 to 20 years, which means they're structured so that you're making payments as if your loan was a 10-year or a 20-year mortgage. However, there's a balloon payment that'll come due after 5 years, sometimes 7 years, depending on your relationship with the bank and the property type and how big the loan is. But for most of us, it's going to be a 5-year balloon payment. And that means at the end of 5 years, you got to pay off that balance somehow. Here's the thing. Nobody pays it off. Everyone refinances. They don't want to pay it off. They want to keep the financing going so the tenant can pay it off. They don't want to dip into their pocket and pay that loan off. So they refinance. Now, what's happened in the last year, the loan rates have almost doubled. In fact, for some people, they have doubled. So they may have bought this property in 2018 and bought it on 3.5%, 4% interest, 5% interest. Now, when they go to refinance, it's going to be 7.5% or maybe even higher. So their payments are going to go way up. And a lot of these commercial real estate loans, this is something that nobody is talking about. A lot of commercial real estate loans are adjustable rate mortgages. They start off at one rate, but when the rate goes up, when the Fed raises the interest rates, they can raise the interest rate on you automatically without even refinancing. So that in itself is causing some issues with commercial property owners. Now, there's a limit on how much they can raise it with these adjustable rate mortgages, but when it comes time to refinance, that's out the window, and they can raise it to whatever they need to raise it to. Here's what's coming over the next 2 years. Now, I had to go back and redo this slide because I got updated numbers. $1.5 trillion in commercial mortgage renewals over the next 2 years. Now, that's not all office buildings. That includes all commercial property types. Office, retail, industrial, and multifamily. And there are some subtypes. You have hotels and restaurants and all kinds of subtypes in there. So all of that stuff has to be refinanced. So here's the problem. Here's why commercial real estate owners are in trouble, and in turn why the banks are in trouble. The banks are tightening their lending standards. It's going to be harder to get a new loan and harder to refinance an existing property. Vacancies and decreases in the net operating income are causing property values to drop. Why is that? Because commercial real estate is valued based on the net operating income that it generates. When you have vacancies, what happens? Your income goes down. You have inflation, your expenses go up. All of these things are causing the property owner's income to go down, and therefore the value of that property to go down. And then on top of that, along comes double the interest rate, and they no longer qualify. That building no longer meets the standards of the lender. The debt service coverage ratio doesn't work anymore. The loan to value ratio doesn't work anymore. Those things that's the math. That's the math that the bank uses to calculate the risk on your loan and decide whether or not they want to loan you the money. Now, the math fails. It's starting to fail. When the math fails, then we've got problems. And that's what's happening right now. And that's why you have owners walking away from properties. Now, why will the banks be in trouble? Because, and I'm talking mostly about small and regional banks now. The big banks, I'm not talking about them. I'm talking about the neighborhood banks, your regional banks. My bank, for example, is a regional bank. It's throughout Texas, probably even beyond the borders of Texas. I'm not sure, but it's a fairly large bank, but it's not a big bank like Bank of America. This is a regional bank, and I won't say the name, but it's a good-sized bank and a well-known bank in Texas. 70% of all these commercial real estate loans are at small banks. 80% of all commercial real estate loans are at local and regional banks. So to say that the banking crisis is not going to hurt them, it hasn't even started yet. This is coming soon to a bank near you, and it's going to be a problem. Now, what are they going to do? Well, this is going to give us some opportunities. The opportunities are going to come in the form of distressed properties and non-performing notes at the bank. The first opportunity here is to buy the distressed properties from the owners. That helps them avoid a foreclosure if they care about that. Why would they not care about it? Well, most people, when they go to buy a commercial property, they will set up a separate company just to own that property. I do that. I have a company that owns all the property that I buy. When I buy property, it goes into that company name. Some people go so far as to have a separate company for each property. I once had a client that he probably had 100 properties, and wasn't really a client. He was well, we won't talk about what he was, but he had about 100 properties, and he had a separate LLC for each property, and he just made the address of the property his LLC name. Now, there are people that do that, and it's legal, and it's common to do, and it's accepted, and it's not shady at all. But what that does is it shields them from personal liability on that property, to where if something happens and they have to walk away from the property, it doesn't affect their main company. That's what these companies like Blackstone have done, and PIMCO, and some of the other companies that have walked away from hundreds of millions of dollars in office properties already. In fact, billions of dollars. Those properties were not in their main company's name, so it didn't hurt their credit any. And they're probably non-recourse loans. Non-recourse loan is exactly what it sounds like. If you default on it, the bank has no recourse. They can't do anything to you for it. All they can do is take the property back. So when it comes to a point to where they are no longer generating enough income to pay the expenses and the debt service on the property, what they've started doing is they're just walking into the lender saying, here are the keys, take the keys, it's all yours. We don't want it anymore. Now that hurts the bank, that hurts the lender. They don't want to own your property. They do not want to have your property back. They will take it if they have to, but they don't want it. So they have to get rid of it. But smaller investors can be damaged a lot by that. And they don't want to be damaged in that way. They don't want their reputation to be damaged with their lenders. So they'll try to sell it first, and they will take a big cut on that property. They will take a huge cut on that property in order to get rid of it before the foreclosure starts. Foreclosures are messy and expensive, and they don't want to deal with it, and neither does the lender. So you get that owner and that lender together with you, and chances are you're going to make a good deal on their property. Here's another opportunity. Buy the note from the bank, hopefully at a discount. If you know of a property that is behind on their payments and they're about to be foreclosed, and you go into the bank and say, hey, can I buy this non-performing note that you have on this property? Chances are they're going to say, well, yeah, if you really want it, you can buy it. And hopefully they'll take a big discount on it because they don't want to go through the foreclosure procedure. So sometimes the foreclosure procedure can cost more than what they're going to get out of the property when they sell it. So when that happens, they don't want it. They don't want to mess with it. That's when you can get a deal from the lender. So why would you want to do that? Well, if you have the note, you can make a deal with the owner of the property. You either give him time to get caught up. You can help him figure out a way to get caught up, figure out a way to turn his property around to a profitable property, or you can foreclose on it yourself. Or the thing I like is you can do a deed in lieu of foreclosure, where they just sign the deed over to you to avoid the foreclosure, skip all the legal mess, and you take possession of the building and then you've got it for whatever you paid for that note. This is done in residential as well as commercial. So if you're a residential investor, you can do this with a house too, by the way. Now, I'm not saying go take over somebody's house and kick them out and take advantage of them. That's not what I'm saying at all. I'm saying if they're willing and they're eager to get rid of it, to save their credit, to save their reputation, then you do that. I like the motto, never sacrifice integrity for growth. And that's part of what that means. You don't do that to take advantage of somebody. You do it to help that person if they want the help. The other opportunity is buy the property from the lender after the foreclosure. Now, they're going to have an auction. You can buy it there too. But if it doesn't sell at auction, then you can buy it from the lender. So when all of this starts to happen, and it's already started, it's going to accelerate. It's going to snowball. The creative deals are going to skyrocket. You're going to see so many different creative deals out there, people willing to do whatever it takes to get out of this property and out of these notes. The note investors are going to come out of the woodwork. The property investors are going to come out, and we're all going to make money on this. There are going to be winners and losers, just like anything else. The thing is, you have to have the mindset that you're here to help some people get out of their problem, get out of their situation that they're in. They're trapped, and they have to get out. And if you have cash, if you have a group of friends that you can pool your cash with, you can help some people out of these properties, and you can make some money on it yourself in the long run. There are going to be master leases, seller financing deals, probably a lot of those. Subject to deals, I don't really like those because every mortgage has a due on sale clause where if you sell the property, it prevents people from assuming a loan and just taking over a loan without telling the bank. If they find out about it, they can call the note and you have to pay it off. But if you do that, one way to do it is you go to the banker, go to the lender and say, hey, this guy wants to get out of this property. I have a way out for him. How far behind is he on his note? I can catch him up. I can take over his note and start paying on it. Will the bank agree to not exercise the due on sale clause? And if they say yes, because you're going to keep them from doing a foreclosure, then you got a deal. And those deals are done on houses and commercial properties. So get ready for those. Use your imagination. These properties, they're going to get sold one way or the other. They're going to get foreclosed. They're going to get taken over by the lenders. They're going to get dumped on the market, or some big investor like Blackstone or BlackRock or one of those people is going to come along and buy packages of these notes from the banks, and they're going to take them over, and they're not going to be nice about it. So it may as well be me and you that get together and get these properties into friendly hands and help the people out of their situation. So you're going to have things other than office properties. As I said, there'll be some industrial properties, some retail properties, and I doubt multifamily is going to be too affected by this, but it can be, because when those mortgage payments go up because of refinancing and higher interest rates, you're going to see some people wanting to dump their apartment complexes because the numbers don't work anymore. The math fails. When the math fails, you got to get out of it. So that's about it for this episode. We'll be back again in a couple of days with another one. Things are starting to move along pretty quickly, and so be sure and subscribe so you can get all the newest episodes. And always remember, one property can change your life. One property made big changes in my life and got me rolling, got me started. And one property can change your life too. So that's it for this episode of Real Estate Revenue, and I'll see you next time.